So, hello everybody. The reason I'm making this video is after we finish up chapter 15, we have a couple more slides. I want to cover chapter 18 today, which we're a little behind, but we should do that. However, there's a couple concepts in chapter 18 which I want to review with you, and I'm going to go to chapter 8 and discuss with you the concept of free cash flow and net working capital. Okay? So I want to do that, and I want to make sure you understand what all that is. And basically, so here I am in chapter 8, and so let's just go through some of these concepts here. And if you have any questions, you can email me or discuss them with me tonight. All right, so this chapter is, and you should read this chapter if you have some time today, determining free cash flow and net present value. All right, so basically in this section, we forecast free cash flow of this company called HomeNet. They're doing a project, and they want to determine what the forecasted free cash flow will be from this project. And they're going to forecast the earnings, and we'll go from there. So let's just go through this. As discussed in chapter 2, there are important differences between earnings and cash flow. And this is an important little blurb. Earnings include non-cash charges such as depreciation. If anybody has any questions on depreciation, you should let me know. We can discuss that. And they also don't include the cost of capital investment for that project, right? So we got to include that, and to go over what their free cash flow is from its earnings, we have to adjust for the fact that we really don't. We want to put back in depreciation and include the cost of capital. All right. So as many of you either know or don't know, depreciation is the basically buying down of an item as it ages. And it's considered a non-cash expense that is paid by the company. It's non-cash. So you see here, rather is a method used for accounting and tax purposes to allocate the original purpose cost over its life. And you'll see, here's the important point. Depreciation is not a cash flow. We do not include it in the cash flow forecast. So we're going to put that back in. So we're going to include the actual cost. So you'll notice here we add back to earnings the depreciation expense for the new equipment, a non-cash charge, and subtract the actual cash expenditure of $7.5 million. That's going to be paid for the equipment in year 0. So we're going to look at that. So we have a combination here. So I want to show you this incremental earnings forecast. You'll notice right about here, line 9, is where the income statement kind of like ends. So, and you'll notice it's unlevered. There's no debt. Unlevered means no debt. Okay, so there's no debt here. And so after that point, we have a little mini statement, 3 lines, of how to calculate the free cash flow. So you'll notice here's the depreciation coming out, and here we are putting the depreciation back in. Okay. We've got to include that back in. Here's the capital expenditures to do this project. You notice it's only the first in the beginning, right? And basically there's an increase in net working capital. Net working capital is the money involved in basically taking care of this project, okay? So net working capital is very important. Now net working capital is simply the current assets on the balance sheet minus the current liabilities, okay? So if I break that down, the current assets includes cash, inventory, receivables, and the current liabilities, payables. So it's important to understand the purpose of net working capital. So most projects will require any company to invest in net working capital. So I just want to read this to you. Firms may need to maintain a minimum cash balance to meet unexpected expenditures and inventories of raw material and finished products, to accommodate production uncertainties and demand fluctuations, So basically, while sales are immediately counted as part of earnings, the firm does not receive any cash until the customers actually pay. And you'll understand that as being accounts receivable, right? So in the interim, the firm includes the amount that customers owe in its accounts receivable. Thus, the firm's receivables measure the total credit that the firm has extended to its customers. In the same way, payables measure the credit the firm has received from its suppliers. So this is the amount you eventually owe, right? And you're gonna, hold off as long as you can on paying it. So the difference between receivables and payables is the net amount of the firm's capital that is consumed as a result of these credit transactions, and these are tied to that project. And this is known as trade credit, which we'll talk about much later. All right, so how do I calculate net working capital? And if we look here, there's a little spreadsheet, okay? And basically, they give you some information up here on what to put. So accounts receivable, 15% of your accounts receivable are going to be paid late. So here's the dollars for accounts receivable. And here's payables, again, 15% of cost of goods sold. These will be, you'll pay these late. So here's my net working capital. And how do I get these numbers? Okay. I simply subtract the payables from the receivables as shown right up here. Okay. So I just want to make sure everyone's aware of where we're going with this. Now, as we move on, basically it says here, any increases in net working capital represent an investment that reduces the cash available to the firm and so reduces free cash flow. You got to understand, net working capital is money you're putting into this project that you would not normally have, okay? So if you're doing a project around your house and you got to dump money into it, that would be considered your net working capital, all right? So you notice here we define the increase in net working capital in year T as, so notice here, there's a delta. Delta means change. So it's important to understand we're going to be looking at the change in net working capital, which will be the net working capital from year T to the net working capital from year T minus 1. So you'll see this show up a lot. So you'll notice here what we're given is that the net working capital increases by $2.1 million. Okay. So each year the net working capital increases. However, notice there is no change in net working capital. It's always, the change is always 0. If I subtract that from that, it's always 0. Okay? So you'll notice what they say here, right? In the years 2 through 4, net working capital does not change, so no further contributions are needed. In year 5, after the project is shut down, net working capital will fall by $2.1 million. Basically, you don't have to shell out the money anymore to fund the project, so you get that money back, right? As they're saying, as the payments of the last customers are received and the final bills are paid. So you add the $2.1 million back to free cash flow in year 5 back in, okay? All right, so now that we have adjusted unlevered, again, unlevered is no debt, right? Net income for depreciation, we put it back in, right? Capital expenditures and increases to net working capital, we compute the free cash flow as shown in line 13 of the spreadsheet. In table 8.3. So if I go to table 8.3, if I go back again, so here we are, all right, and we're going to determine the free cash flow. We're putting everything back in here, okay? Note that in the first 2 years, free cash flow is lower than the unlevered income, all right, reflecting the upfront investment in equipment and net working capital that is required by the projects. In later years, free cash flow exceeds unlevered income. And again, depreciation is not a cash expense. It's an accounting term, all right? All right, so I will pick this up in part 2. I don't want these to get over 10 minutes because I have trouble uploading them. So we'll pick up on example 8.4 and look at that, okay? All right, thank you.